Chapter 21 Summary. Capital budgeting is planning to invest in long-term assets in a way that returns the greatest profitability to the company. Capital rationing occurs when the company has limited assets available to invest in long-term assets. The four most popular capital budgeting techniques are used are payback period, rate of return, net present value, and internal rate of return. The payback period focuses on the time it takes for the company to recoup its cash investment, but ignores all cash flows occurring after the payback period. Because it ignores any additional cash flows, including any residual value, the method does not consider the profitability of the project. The rate of return, however, measures the profitability of the asset over its entire life using accrual accounting figures. It is the only method that uses accrual accounting rather than net cash inflows in its computations. The payback period and rate of return methods are simple and quick to compute, so managers often use them to screen out undesirable investments. However, both methods ignore the time value of money. Invested money earns income over time. This is called the time value of money, and it explains why we would prefer to receive cash sooner rather than later. The time value of money means that the timing of capital investments, net cash inflows, is important. The cash inflows and outflows are either single amounts or annuities. An annuity is equal cash flows over equal time periods at the same interest rate. Time value of money tables in Appendix B help us to adjust the cash flows to the same period, for example, today, or the present value, or a future date, or the future value. The net present value is the net difference between the present value of the investment's net cash inflows and the investment's cost, cash outflows, discounted at the company's required rate of return, or the hurdle rate. The investment must meet or exceed the hurdle rate to be acceptable. The internal rate of return is the interest rate that makes the cost of the investment equal to the present value of the investment's net cash inflows. Capital investment budgeting methods that consider the time value of money, like net present value and internal rate of return, are best for decision making.